In my October letter, I raised my silver target from 75 to 100. In my most recent letter that came out last week, first quarter letter, I raised it again to 125. Because we're in a parabolic, that 125 could just easily be 135 or 45. I raised my target on gold to 5,500 from, I guess it was 5,000. Yeah, I raised it in October to 5,000 and just raised it again to 5,500. My current targets are the same. They were 9,500 for the S&P, 65,000 for the Dow, 32,000 for the NASDAQ, and the Russell I raised to 3,800 back then. So, basically 40 to 50% upside from here. A little less than that for the Dow and the S&P, but I'm fully on board with that forecast, very comfortable with that forecast. Think we're going to see a lot of it in the first quarter and probably spill over into the second quarter.
As of January 19th, 2026, the precious metals market is in the midst of an explosive record-breaking run. Gold has surged past $4,670, and silver is touching $94, driven by a perfect storm of geopolitical chaos. Specifically new U.S. tariff threats against Europe over Greenland and rising tensions in the Middle East. With central banks aggressively accumulating and a massive physical supply squeeze unfolding, experts warn that the current parabolic move is far from over. In this video, we sit down with legendary contrarian macro strategist DavidHunter, who just raised his targets again in his latest first quarter letter. Hunter is calling for a massive final meltup in 2026. Setting staggering new price targets of $5,500 for gold and $125 for silver. He believes we are witnessing a historic broadening of the bull market, where even small-cap stocks and materials will skyrocket before a global bust. But with silver going vertical, is there a limit to how high this can go before the burnout begins? Watch until the end to see why David thinks this move will be the biggest in history. Don't forget to like, subscribe, and enable notifications for additional in-depth content. Thanks for joining us again. Enjoy the video.
My fourth quarter letter came out in early October. You already know this, I think, because my letter had been out, but I raised targets back there for the S&P and the NASDAQ, the Dow, and the Russell. So my current targets are the same. They were 9,500 for the S&P. 65,000 for the Dow, 32,000 for the NASDAQ, and the Russell I raised to 3,800 back then. So, basically 40 to 50% upside from here. A little less than that for the Dow and the S&P, but I'm fully on board with that forecast, very comfortable with that forecast. Think we're going to see a lot of it in the first quarter and probably spill over into the second quarter. I think it is a first half event, as has been my nature. I'm always extending things because the market decides when it's going to top out, but at least right now that looks like a pretty good forecast. I think in the very short term, you could see a 3, 4, 5% pullback in the market. It's rolled over the last couple of days. There's any number of things out there, including Iran, that could trigger a quick sell-off. So I just see, when I look at the charts and things, some potential. It doesn't have to do it, but some potential. So you might take the S&P down to, I'm just looking at numbers I looked at this morning, maybe down towards 6,700. And I'm not sure, NASDAQ might be a little more percentage-wise, but basically it'd be just to pause it, refreshes, a quick reaction to some things. You got tariff things, if the courts rule on that could trigger a sell-off. Or we're in the middle of earnings season, just beginning earnings season, so it's something there could do it. It's not any kind of a reversal. It's just a quick kind of, it's gotten a little overbought. It wouldn't surprise me if this little rollover we've seen the last 2 days extends for another few days. But I'm hugely bullish. I think the bull market will be driven by lower rates. I keep saying the bond market, I think, is poised for a big move in 2026. I am also obviously can't ignore what's going on in the metals. I mean, we are seeing moves there, particularly in silver, like we never have seen before. I did in my October letter, I raised my silver target from 75 to 100. In my most recent letter that came out last week, first quarter letter, I raised it again to 125. So I'm looking for, still a lot more upside here. And as I said in my letter, because we're in a parabolic, that 125 could just easily be 135 or 45. It's when you get into that vertical, there's no magic to what point it stops. It's going to burn out quickly at some point. But I think there's still plenty of upside ahead. The institutions still aren't on board with the silver or gold, really. Gold more than silver, but silver, I think, probably has the more upside here. I raised my target on gold to 5,500 from 40. I guess it was 5,000. Yeah, I raised it in October to 5,000 and just raised it again to 5,500. So, and the other one, copper, which I have maintained the $7 number since early last year. When they announced tariffs in April or soon thereafter, some tariffs on refined copper, it dropped down. It had touched $6, dropped down to like 4 or 4.25, and it's back up over 6. I just raised my target on copper to $8. So, metals of all kinds, I think, are rolling here. The materials ETF is breaking out and looks like it's got lots of upside ahead. And we're seeing a broadening in the market right now. The Mag 7 is taking a rest right now. The semis, at least in the last couple of days, are taking a bit of a breather. But ultimately, I think it's going to be everything moves. It's going to be across the board. Most of the market is going to be the small caps, the large caps. We should have a pretty good next 3 to 6 months.
In this segment, DavidHunter pivots to the global macro factors fueling this historic surge. He explains how central banks and BRICS nations are aggressively accumulating gold to challenge the dollar's dominance with a potential gold-backed currency. With global debt hitting a staggering $330 trillion, Hunter argues that money printing is the only path forward, making hard assets the ultimate hedge. He also predicts a dramatic bond market rally with rates dropping to 3% by mid-year, providing a massive tailwind for stocks. Is the soft landing narrative finally becoming a reality? Let's hear directly from DavidHunter.
Yeah, certainly for the central banks and certainly for the BRICS, they think if they can accumulate gold and move to some sort of a gold-backed currency, that they can compete with the dollar. And I think that's their long-term plan. And it's that plus the fact that I think for all central banks in all countries, everybody kind of could step back and say, the world we live in today is uncertain. The fiat currency environment is uncertain. We want some gold as a hedge or a protection against what it looks like, which is to get out of this massive debt of 330 trillion around the world. There's only one way you're going to get out of that, and that's to print more money, right? And you're not going to get out of it, but the only hope you have is to print more money. So it seems naturally that you would want something that moves up with inflation, moves up with, liquidity. And I think that's a lot of what's behind gold kind of from afar. Near term, it's more the central banks are buying it and there's not enough gold around. We've been in a 2-year basing process for the bond market. Everybody wants to be bearish bonds, or at least, long bond. They're talking about it going up, rates going up, not down. And people are discouraged because the 10-year, is stuck in this trading range between 4 and 420. I think we are poised for a move down to 3% and below in the next 6 months. So by mid-year, probably 3% and maybe below 3%. That's a big move to go from 4.15 or wherever we are today down to 3%. So one is rates down, and I don't care what the Fed does. Everybody wants to focus on the Fed. The bond market's, I think, ready to rally either way. Um, the dollar, as you know, I have a target of 82 on that. I think it's very close to the end of a 6 month consolidation. Maybe it's longer than that even. Um, and we'll roll over and head for 90 and then probably consolidate again before it heads for 82. Big drop in the dollar will help, I think help. Um, I also think you have an underestimation of just how much is going on in the Trump, not you, but the street, just how much is going on in the Trump agenda. You've got deregulation, you've got the big beautiful bill. There's a lot of things that don't kick in until now. So I think there's a lot of things like that that will be received by certainly the institutions as they see it starting to happen. They're going to become more bullish on that. I think the narrative that you will get over the course of the next 6 months is going to be moving more and more towards either a soft landing or not even a soft landing. That this thing is gaining some legs. That the Fed's just beginning a new easing cycle. Not so much from a rate standpoint, but from a monetary standpoint. They pulled the balance sheet down from 9 trillion to 6.5 trillion, and they're now having to pump money in again because the banking system's needing it. So you're starting to pump money again. I think you're going to see as we move towards the second quarter, the rhetoric is going to be, the narrative is going to be, this thing has legs. The Fed's just beginning. This thing can carry for a couple more years. Um, Interest rates are coming down, so the multiples can expand even further. Earnings, which have been remarkably good through all of this, may accelerate or at least stay just as good.
DavidHunter's final warning is clear. We are nearing the peak of a 43-year secular bull market, a last hurrah fueled by a late-stage parabolic meltup. While his targets of $5,500 gold and $125 silver reflect massive near-term upside, he cautions that this euphoria precedes a historic deflationary global bust that could dwarf the 2008 crisis. Hunter anticipates an eventual 80% market collapse, triggered by extreme leverage and systemic fragility before central banks respond with an unprecedented $20 trillion stimulus. The question remains, are you positioned to capture the final surge, or will you be caught in the biggest reversal of our lifetime? Share your thoughts in the comment section below. If you found this breakdown helpful and want to stay ahead of these historic market moves, make sure to like, subscribe, and turn on notifications so you never miss an update. Your support helps the channel grow and keeps you informed when the markets shift next.